In modern financial markets, data is the lifeblood of successful trading strategies, especially in arbitrage. The ability to collect, process, and analyze vast amounts of data has revolutionized how traders identify and exploit market inefficiencies. Section 1. Data collection and analysis. Identifying relevant data sources. The effectiveness of any arbitrage strategy hinges on the quality and timeliness of the data. Different arbitrage strategies require different types of data, and choosing the right data sources is crucial. Market data. This includes real-time and historical prices of securities, currencies, commodities, and other financial instruments, typically provided by exchanges, financial data vendors, and trading platforms. For statistical arbitrage, access to detailed price data is essential. Order book data provides insights into market supply and demand by displaying buy and sell orders at various price levels. This data is useful for high-frequency trading and understanding market depth and liquidity. News and sentiment data. News agencies, social media platforms, and financial news websites provide data to gauge market sentiment. Sentiment analysis tools process this data to quantify the market's mood, useful for predicting short-term price swings. Economic indicators. GDP growth rates, inflation figures, interest rates, and employment data influence market prices and create arbitrage opportunities when there are discrepancies between expected and actual data releases. Corporate data. Earnings reports, financial statements, and merger announcements are crucial for strategies like merger arbitrage or equity arbitrage. Alternative data includes data from satellite imagery, web traffic, and credit card transactions, providing unique market insights not captured by traditional data sources. Data collection techniques. Once relevant data sources are identified, collecting data efficiently and accurately is the next step. APIs and data feeds. Many financial data providers offer APIs for accessing live price quotes, order book data, and other relevant information directly into trading systems. This method is crucial for high-frequency trading and automated arbitrage strategies. Web scraping. Automated tools extract data from websites. This technique collects news, sentiment data, or alternative data from publicly available sources. Historical data downloads. Traders can download large datasets from financial data providers, exchanges, or public databases for backtesting and historical analysis. Data aggregation platforms. These platforms compile data from multiple sources, offering customizable dashboards, data visualization tools, and advanced analytics for real-time monitoring and analysis. Data processing and cleaning raw data often needs processing and cleaning before analysis. This step involves organizing, structuring, and transforming data into a suitable format for analysis while correcting errors, inconsistencies, and outliers. Data structuring organizes data into a consistent format, such as time series data for prices or tabular data for order books, facilitating accurate comparisons between data sets. Data storage and security. Ensuring that collected data is stored securely and remains accessible is vital for effective arbitrage trading. Use robust data storage solutions that provide high availability and redundancy. Implement strong security measures to protect sensitive data from unauthorized access and breaches. Cloud storage. Cloud-based solutions offer scalability and flexibility, allowing traders to store large volumes of data and access it from anywhere. Cloud storage providers also offer advanced security features, such as encryption and multi-factor authentication. On-premises storage. For those who prefer to keep data in-house, on-premises storage solutions provide direct control over data security and access. This approach may be more suitable for sensitive or proprietary data. Section 2. Analytical techniques for arbitrage. Once data is collected, processed, and cleaned, the next step is to analyze it to identify arbitrage opportunities. Various analytical techniques can be employed depending on the data type and the specific arbitrage strategy. Statistical analysis. Statistical analysis uses mathematical models to identify patterns, correlations, and trends in the data. Techniques such as mean reversion analysis, cointegration tests, or correlation analysis help identify pairs of securities likely to converge in price. Statistical tools like regression analysis, standard deviation, and variance quantify relationships between variables and assess the likelihood of price movements. Mean reversion analysis. Mean reversion is a financial theory suggesting that asset prices and historical returns eventually revert to the long-term mean or average level. In statistical arbitrage, traders use mean reversion analysis to identify securities that have deviated from their historical average price. When prices revert to the mean, traders can profit from the correction. Correlation analysis. Correlation measures the relationship between two variables, indicating how they move relative to each other. In arbitrage trading, correlation analysis helps identify securities with strong positive or negative correlations, allowing traders to construct strategies based on expected price movements. Technical analysis. Technical analysis focuses on price charts and technical indicators to predict future price movements. Traders use indicators such as moving averages, relative strength index RSI, or Bollinger Bands to identify overbought or oversold conditions, potential reversals, or breakout patterns. Technical analysis is useful for short-term arbitrage strategies where timing is critical. Bollinger Bands. Bollinger Bands consist of a moving average and two standard deviation lines. The bands expand and contract based on price volatility. When prices touch or move outside the bands, it can signal overbought or oversold conditions, indicating potential entry or exit points. Sentiment analysis. Sentiment analysis quantifies the market mood based on textual data from news articles, social media posts, or earnings call transcripts. Natural language processing (NLP) techniques analyze large volumes of text data to extract sentiment scores. These scores help predict market reactions and identify arbitrage opportunities based on shifts in sentiment. Sentiment scoring. Sentiment scoring assigns a numerical value to the sentiment expressed in textual data. Positive sentiment scores indicate optimistic market sentiment, while negative scores indicate pessimistic sentiment. Traders use sentiment scores to gauge market reactions and identify trading opportunities. Machine learning analyzes large data sets, identifies complex patterns, and makes predictions. Algorithms trained on historical data recognize recurring patterns indicating arbitrage opportunities. Techniques like supervised learning, unsupervised learning, and reinforcement learning are commonly applied in quantitative trading strategies. Supervised learning. Supervised learning algorithms are trained on labeled historical data to make predictions. Common algorithms include linear regression, decision trees, and support vector machines. These models identify patterns and relationships in the data, predicting future price movements. Unsupervised learning. Unsupervised learning algorithms analyze data without labeled outcomes, identifying hidden patterns and structures. Techniques like clustering and dimensionality reduction help uncover relationships and group similar data points. Reinforcement learning. Reinforcement learning algorithms learn through trial and error, optimizing actions based on feedback. In trading, reinforcement learning models adapt strategies in real time, continuously improving performance based on market conditions. Backtesting. Backtesting applies an arbitrage strategy to historical data to evaluate its performance under different market conditions. By simulating trades based on past data, traders assess the strategy's effectiveness, identify potential risks, and refine their approach before deploying it in live markets. Backtesting also optimizes parameters, such as entry and exit points, to maximize returns. Historical simulations. Historical simulations involve applying a trading strategy to historical data, simulating past trades, and evaluating performance. Traders analyze key metrics, such as returns, volatility, and drawdowns, to assess strategy robustness. Parameter optimization. Backtesting helps optimize strategy parameters, such as entry and exit thresholds and risk management rule. Predictive analytics. Predictive analytics uses historical data and statistical models to forecast future market behavior, identifying potential arbitrage opportunities with greater accuracy. Time series analysis. Time series analysis examines historical price data over time to identify trends and seasonal patterns, using models like ARIMA or exponential smoothing to predict future price movements based on past behavior. Regression analysis. Regression analysis models the relationship between asset price and independent variables like trading volume or economic indicators, helping to predict future prices in arbitrage trading. Machine learning in predictive analytics. Machine learning algorithms such as decision trees and neural networks analyze large data sets to predict future price movements with high accuracy, identifying nonlinear relationships valuable in dynamic markets. Applications of predictive analytics in arbitrage. Identifying arbitrage opportunities. Predictive models forecast price discrepancies, identifying profitable arbitrage opportunities. Optimizing trade execution. Predictive analytics optimizes trade timing, identifying optimal moments to enter or exit trades. Risk management. Predictive analytics aids in risk management by forecasting volatility to adjust strategies accordingly. Using high-quality data and analytical techniques, traders can identify and exploit arbitrage opportunities with precision, balancing analytical rigor with strategic execution.